Welcome to Smart Wealth with Joshua. I'm Alex.
And I'm Sarah, your daily stock analysis and catalysts talk. Today we're looking at Reddit.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine you find this massive, highly sought after commercial asset, right?
Yeah.
And it's generating nearly $700 million in pure cash.
Yeah.
It's growing its top line revenue at like 70%.
Which is huge.
Right. It's massive. But then you realize the broader market just, blindly tossed it into a 39% off clearance bin.
Yeah, just completely discarded it.
Exactly. So today we are tearing apart the financials of a company that has completely rewired its underlying business model. And Wall Street was, well, they were totally distracted.
They really were.
So if you are looking for that rare value growth intersection to really anchor your portfolio, this is the anomaly you absolutely need to understand. But before we even touch that chaotic stock chart, we have to look under the hood. We need to look at the business fundamentals because, the numbers here don't just point to a good quarter.
Yeah, not at all.
They point to a massive, permanent structural shift.
They absolutely do. And, when you are building long-term wealth, this is exactly the type of mechanical shift you are hunting for.
Right.
Let's just look at the reality of their fourth quarter in 2025. Their revenue hit $726 million.
Wow.
Yeah, that is a staggering 70% year-over-year increase. And to put that into the proper wealth-building context for you, the Wall Street consensus was modeling for $665 million.
So they didn't just barely beat it.
No, they completely obliterated those estimates.
A 70% increase for a platform of this maturity is almost unheard of. It basically defies the law of large numbers.
It really does.
But to really grasp what is happening here, I want you to think about an analogy. Think of their old business model like a massive, chaotic, completely unmonetized piece of prime digital real estate.
Like a giant house party.
Yeah, exactly. It's like the world's biggest, messiest college dorm.
Yep.
You have tens of millions of people hanging out. There is incredible foot traffic, massive cultural influence, but nobody is paying rent.
Right, the landlord just letting them squat there for free.
Exactly. And what management has done over the last year is essentially flip a switch. They renovated that messy dorm and turned it into a premium, high-margin commercial asset.
Which completely changes the valuation.
It does. But this is the critical question you have to ask when you're evaluating a stock like this. Is this 70% revenue surge just, a temporary traffic spike? Or is this a permanent mechanical upgrade to how the business prints money?
Well, it is entirely structural.
Yeah.
And here is why you need to care about that distinction for your own portfolio. Management didn't achieve this just by buying raw traffic.
Right. They're just paying for clicks.
Exactly. It's not some marketing gimmick to get more eyeballs. They achieved this through surgical improvements in their ad loading and pricing efficiency.
So they're just getting smarter about it.
Much smarter. They finally figured out how to monetize the massive crowd that was already inside the building. Look at the global average revenue per user, the ARPU.
Okay, what did that look like?
It surged 42% globally. And in the United States, which is obviously their most lucrative market, it was up 50%.
Wait, so they are extracting 50% more revenue from the exact same American user base?
Precisely. The users didn't change, the efficiency did. And because this growth is driven by efficiency rather than, massive user acquisition costs, it comes with extreme operating leverage.
That makes sense.
Yeah. They posted an adjusted EBITDA margin of 45%. Earnings per share came in at $1.24, which completely destroyed the 94-cent estimate.
Wow.
But the most vital metric for you as an investor, the one that really dictates long-term compounding wealth, is a gross margin.
Okay, lay it on us.
It is currently sitting at an astronomical 91%.
Okay, let's pause right there. We cannot just gloss over a 91% gross margin.
It's massive.
It really is. If you typically invest in hardware or automotive or like traditional retail stocks, you are used to seeing gross margins sitting around 20 or maybe 30% on a good day.
Exactly.
So break down the actual mechanics of operating leverage for the listener. What does a 91% gross margin actually mean when a company is trying to scale?
Well, it is the ultimate wealth-generating engine. Operating leverage just means your fixed costs. So your servers, your core engineering team, your real estate, they are all already paid for.
Right. The foundation is set.
Exactly. So when a company has a 91% gross margin, it means that for every brand new dollar of advertising revenue that comes through the door, 91 cents of it is essentially pure profit before we account for broader operating expenses.
That's incredible.
It is. There is virtually zero marginal cost for them to serve one additional ad to a user. It costs them absolutely nothing to duplicate the digital product.
So the infrastructure is built, the pipes are laid, and now the water flowing through them is almost pure profit.
That's the perfect way to look at it. And, the proof is in the free cash flow. In the fourth quarter alone, they generated $264 million in free cash flow.
Just in one quarter?
Just Q4.
Right.
Over the trailing period, we're talking about $684 million in pure cash.
Wow.
So this isn't some speculative, unprofitable tech story hoping to make money in, 2030. This is a compounding wealth machine that is operating right now.
Okay, but this forces us to ask the next logical question, right?
Sure.
If this massive profitability is being driven by better ad pricing and efficiency, what makes their specific ad inventory so uniquely valuable right now?
That's the billion-dollar question.
Right. Like, why are advertisers suddenly willing to pay a massive premium to be there? And that brings us to the second pillar of this investment thesis.
The data moat.
Yes, their highly specific human data moat. We are looking at a platform with 121 million daily active unique visitors.
It's a massive audience.
It is. But the killer metric here is that 90% of those users trust the platform for product discovery.
And that 90% trust metric, that is the holy grail for advertisers.
Why is that?
Think about your own behavior. When you want to buy a new vacuum cleaner or, say, a piece of audio equipment, you don't go to a sterile search engine anymore.
No, I usually append the name of this platform to my search.
Exactly, because traditional search results are clogged with SEO spam and sponsored articles. You want authentic, unfiltered advice from real human beings who actually use the product.
Right, you want the real reviews.
Yes, and that level of trust creates incredibly high switching costs. Users are not going to abandon that authenticity for a generic search bar.
That makes total sense.
And advertisers know that these users are at the very bottom of the purchasing funnel. They have incredibly high intent. They are actively researching what to buy today.
Okay, but I have to push back hard on this premise just on behalf of the listener weighing the risks here.
Go for it.
You are telling me Fortune 500 companies are eagerly dropping millions of dollars into the exact same platform that is famous for chaotic, meme stock rebellions and completely unregulated forums.
It sounds a bit crazy on paper, yeah.
Right. Like, if I'm a chief marketing officer at a legacy blue chip brand, that sounds like a career-ending brand safety risk, not a premium data moat. How is this actually viable for enterprise advertisers?
Well, it's a totally valid concern. And for a long time, that exact fear kept those legacy brands away.
Yeah.
But the mechanics of digital advertising have shifted, and the platform has heavily upgraded its contextual targeting.
What does that mean in practice?
It means they aren't just blindly throwing a brand's ad onto the front page next to controversial news.
Oh, I see.
Because the platform is naturally divided into thousands of highly specific, hyper-focused interest communities, brands can utilize incredibly safe contextual targeting.
Give me an example of that.
So if you are a high-end hiking boot brand, you can place your ad exclusively within a dedicated wilderness backpacking community.
Right, where everyone is talking about trails and gear.
Exactly. You know exactly what the context is, and you know the audience is entirely composed of outdoor enthusiasts. The brand safety is built directly into the architecture of the communities themselves.
Oh, right, that clears that up. But let's tackle the other huge buzzword here.
Oh boy, I know it's coming.
Yeah, every tech startup with a pitch deck right now is claiming they have an AI moat.
Yep.
And the narrative around this stock is that it is the undisputed antidote to AI model collapse.
Which is a bold claim.
Very bold. So is this just tech buzzword bingo to pump the valuation, or is this corpus of human conversation actually driving tangible enterprise revenue today?
I get the skepticism, but it's not just a buzzword. It is a mechanical necessity for the future of artificial intelligence.
Okay, explain that.
Well, we have to understand what model collapse actually is first. Large language models train by consuming massive amounts of data across the internet.
Right.
But as the internet fills up with AI-generated articles and synthetic text, new models are starting to train on AI-generated data.
It's an echo chamber.
Exactly. It's like taking a photocopy of a photocopy of a photocopy. The model eventually degrades and collapses into complete nonsense.
So they need fresh data.
Yes. The only antidote is fresh, continuously updated, authentic human conversation. That is the raw material that prevents model collapse.
And this platform has it.
They hold the largest real-time repository of it in the entire world.
But how does that theoretical data value translate into actual ad revenue right now? Let's talk about the plumbing.
Let's do it.
Look at the partnership they just launched on March 17th, 2026 with Pacvue.
Right.
We really need to explain the mechanics here. What does Pacvue actually do, and how does it move the needle for the stock?
This is exactly where the theoretical becomes highly profitable today. So Pacvue is an AI-powered commerce operating system used by massive, big-budget enterprise brands.
Like the really big players.
Yes. Before this partnership, if a brand like Samsung wanted to buy ads here, it was a manual, high-friction process, completely outside of their normal workflow.
It was a hassle.
A huge hassle. They had to log into a separate dashboard, manage a separate budget, and monitor separate analytics.
I can see why CMOs wouldn't bother.
Exactly. But what the Pacvue integration does is remove all of that friction entirely.
How so?
It takes this highly valuable, high-intent ad inventory and puts it directly onto the exact same dashboard these enterprise brands are already using to manage their Amazon and Walmart retail media.
Oh, wow. So it's right there in front of them.
Exactly. It makes it literally one click for a chief marketing officer to allocate millions of dollars in ad spend to this platform.
Which changes everything.
It does.
Yep.
That seamless integration is exactly what is driving that 50% surge in U.S. average revenue per user we talked about earlier.
That makes perfect sense. They simply removed the roadblock between the advertiser's wallet and the platform's inventory.
Exactly.
So let's recap the reality of the business right now. We have stellar financials, a 70% growth rate, 91% gross margins, generating massive free cash flow, and a deeply monetizable high-intent data moat.
A phenomenal setup.
It is, which logically brings us to the absolute elephant in the room.
The stock price.
Right. If the underlying business is functioning like a Swiss watch, why has the stock chart looked like a disaster zone, and what is the institutional money doing about it?
It is the ultimate disconnect in the market right now.
It really is.
If you look at the technical backdrop, the chart has formed what we call a washout and reversal pattern.
Walk us through the timeline on that.
Sure. Back in September 2025, the stock was flying high, hitting an all-time high of $270.
Okay.
But by mid-March 2026, it had plummeted down to around $140.
That is brutal.
Yeah, that is a 39% year-to-date drop.
A 39% drop while the core business is simultaneously growing revenues at 70%. That feels completely contradictory.
It definitely confuses a lot of people.
Let's ground this in a wealth building analogy for you. This
Yeah.
isn't just finding a good deal, It is like finding a pristine Ferrari priced like a used Honda Civic.
Yeah.
Simply because the specific dealership it was parked in had a bad month and had to liquidate everything.
That's a great way to picture it.
Right. So when you see a 39% drop like that, despite record profits, you have to ask yourself, was this just a brutal flushing out of weak retail hands, or is the market seeing a fundamental flaw that we are missing?
Well, it is primarily driven by macro market mechanics. And understanding this is really crucial for your wealth strategy.
Okay, break it down.
What caused that drop wasn't a failure of the business itself. It was a massive macro sector rotation.
Explain what that means for the listener.
Imagine a giant pool of institutional capital. For a long time, it was heavily concentrated in anything categorized as high-growth software.
Everyone loved growth.
Right. But as macroeconomic conditions shift, massive hedge funds and pension funds rotate that capital out of high-multiple growth names, and they put it into safer, profitable value plays.
So it's basically algorithmic passive selling.
Yeah.
When the big funds hit sell on the broader tech sector, this stock just got caught in the crossfire.
Exactly. It gets pulled down with the tide, regardless of its individual merit.
Unbelievable.
But that blind selling creates a profound generational disconnect for the individual investor paying attention.
Because it creates a discount.
A huge one. Because of that 39% drawdown, the stock is currently trading at roughly a 25x earnings multiple.
Okay, let's make sure the listener grasps how absurd that actually is.
Please do.
A 25x earnings multiple for a digital platform growing its top-line revenue at 70%.
It is a screaming anomaly in modern finance.
It really is.
Think about it. A 25x multiple is the kind of valuation you expect to pay for a mature, slow-growth consumer staple company.
Like a beverage manufacturer or something.
Exactly. A company that grows at like 4% a year. You do not see a 25x multiple on a software asset expanding its margins to 45%.
Never.
And make no mistake, the institutional smart money sees this exact same pricing error.
Yeah, we saw the evidence of that just days ago. On March 16th, the stock surged 5.77% on extremely heavy volume right after that positive Pacvue news broke.
A clear signal.
Absolutely. That tells us event-driven institutional buyers are actively stepping in at these levels. We also know that top-tier funds like Tiger Global maintain a strong presence here.
Which is huge validation.
It is. That fits the exact profile of a high-conviction fundamental growth play favored by the smartest people in the room.
And beyond the institutional funds, we cannot ignore the loudest, most definitive signal in the entire financial ecosystem.
The buyback.
Yes, management just officially authorized a $1 billion share repurchase program.
I love talking about buybacks because it is the ultimate lie detector test for a board of directors.
It really puts their money where their mouth is.
Exactly. Talk is cheap, but $1 billion is definitive. Break down why that specific move fundamentally alters the risk profile for the listener.
Well, when management commits $1 billion in cash to buy back their own stock, they are screaming to the broader market that their asset is drastically mispriced.
They think it's too cheap.
Yes. The board of directors is looking at their $684 million in trailing free cash flow. They are surveying the entire landscape of potential acquisitions or investments, and they are deciding that the absolute highest return on their capital is simply buying their own shares at a 25x multiple.
That is massive confidence.
It is. And by constantly buying shares on the open market and retiring them, they're effectively placing a massive concrete floor under the stock price.
So it limits how far it can fall.
Exactly. It drastically limits your downside risk.
Okay, so the upside thesis is incredibly robust. You have cash flow, extreme growth, multiple compression, and $1 billion buyback floor.
It checks all the boxes.
It does. But no investment is completely bulletproof, right?
Never.
If you are going to allocate capital and build a position here, you need to understand the actual threats that could prove the bears right. What are the specific risks, and what are the upcoming calendar events that will force the market to finally wake up and reevaluate this multiple?
Well, the first major risk you have to monitor is regulatory headwinds.
Always an issue in tech.
Especially here. This is a global data business, and they recently absorbed a multi-million-pound fine from the UK Information Commissioner's Office.
What was that regarding?
It was regarding children's data protection.
Let me stop you right there to ask a direct question on behalf of the listener.
All right.
When you are analyzing a stock and a headline flashes across your screen about a multi-million-pound regulatory fine in Europe, should a long-term investor view that as a fundamental crack in the thesis? Or is that simply the inevitable structural cost of doing business at a global scale?
You always have to weigh the penalty against the cash generation engine.
Right.
It's all about proportion. Yes, this fine highlights the reality of increasing regulatory scrutiny worldwide. That scrutiny will inevitably impose higher long-term compliance costs.
Sure.
And it may eventually limit how aggressively they can use certain data for ad targeting. But remember the context we established earlier.
The free cash flow.
Exactly. This is a company that generated $684 million in free cash flow over the trailing period alone.
It's a drop in the bucket.
Yes. In that context, a multi-million-pound fine is highly manageable. It is essentially a corporate parking ticket.
A parking ticket, I like that. Right.
Yeah, it's a headline risk that creates volatility, but it does not break the foundational thesis.
Okay, what about valuation sensitivity? We keep praising the 25x multiple, but is there a risk if that 70% growth rate suddenly hits a wall and starts to decelerate?
That is the more significant mechanical risk for sure.
How so?
The market is still pricing in the expectation of sustained high-level growth. If that 70% growth rate suddenly decelerates to, say, 20%, the growth justification for the multiple starts to evaporate.
Right, the narrative changes.
It does.
Yeah.
But again, the fact that the multiple has already compressed down to 25x heavily mitigates this danger.
Because it's already cheap.
Exactly. If you were paying 100x forward earnings, even a slight miss on revenue would cause the stock to get cut in half overnight.
That's a scary position to be in.
Very. But because the 39% drawdown has already occurred, the valuation is heavily de-risked. You are paying a value price for a high-growth asset.
So the downside risk is heavily mitigated by the cheap valuation. But what actually forces the market to wake up and correct this? What triggers the rebound? Let's look at the catalyst calendar over the next few months.
Well, the undeniable focal point will be the Q1 2026 earnings release.
When is that coming out?
That'll be in late April or early May. The consensus already expects another earnings beat, but Wall Street is forward-looking.
Right, they care about the future.
Exactly. The crucial piece of information will be their forward guidance. That guidance is the ultimate catalyst needed to prove to analysts that the incredible Q4 numbers weren't just a seasonal, holiday-driven fluke.
They need to prove it's a sustainable, mechanical trend.
Right. If management raises their full-year 2026 guidance, it forces every major analyst to open their spreadsheets and revise their price targets upward.
We also have the spring 2026 Pacvue product launch to track.
Yes, that's huge.
When that goes fully live, any success stories or case studies showing enterprise brands getting massive returns on their ad spend will be a huge sentiment driver.
It proves the plumbing actually works.
Exactly. And then there is an unconfirmed rumor floating around the market right now that we absolutely have to discuss.
Yes, the index inclusion rumor.
Yes. Because of their sustained profitability and growing market cap, there is serious chatter about potential inclusion in the S&P 500 index.
Which would be massive.
Now, we aren't just talking about a prestige badge here. We are talking about mechanical market forces. Walk the listener through the actual math of what happens to a stock's price when it gets added to the S&P 500.
Oh, it creates a massive structural supply and demand imbalance that has absolutely nothing to do with the company's fundamentals.
How does that work?
Well, there are trillions of dollars in passive index funds and ETFs out there that strictly mirror the S&P 500.
They're like your standard retirement funds.
Exactly. If this stock is added to the index, every single one of those funds, from Vanguard to State Street to BlackRock, is mechanically forced to buy the stock to match their portfolio weightings.
They don't have a choice.
No choice at all. It is completely price-agnostic buying.
Yeah.
They don't care about the 25x multiple. They just have to buy it.
So it's basically guaranteed demand.
Yes. This creates an enormous wave of passive capital flooding into the stock, driving the price up.
Wow.
Now, it is unconfirmed, so you don't build your entire wall strategy around it, but it is a massive potential tailwind that you must keep on your radar.
Absolutely. Well, we have covered an immense amount of ground today, tearing down the mechanics of this business. Let's summarize the final investment thesis so you can accurately position this within your own portfolio.
Sounds good.
After looking at the structural turnaround from an unmonetized forum to a commercial asset, the $684 million in trailing cash flow, the highly defensible human data moat, and the severe multiple compression down to 25x. We are officially awarding this stock a bullish score of 9 out of 10. We are designating it a long-term core holding for a 12 to 18-month time horizon.
And, the ultimate takeaway for you as an investor today is to look past that terrifying 39% technical drawdown on the chart.
Don't let it scare you.
Exactly. That was a macro rotation, not a fundamental failure. Instead, focus your attention purely on the underlying cash machine.
The actual business.
Right. You have a business that is rapidly expanding its margins to 45%. Armed with a brand new $1 billion buyback program that provides a massive safety net.
The floor is set.
It is. The intelligent move is to utilize this current technical weakness to build a position now, before the Pacvue integration scales and the Q1 earnings officially confirm the growth narrative to the rest of the market.
It is all about finding that rare value growth intersection when everyone else is looking the other way.
Exactly.
But before we wrap up today's analysis, I want to leave you with a final provocative thought to ponder on your own. We spent a lot of time discussing how this specific platform is the undisputed antidote to AI model collapse because of its rich corpus of human conversation.
Dude.
But as these massive artificial intelligence models continue to aggressively devour the entire internet, they're inevitably going to face a severe scarcity of fresh, authentic human data.
The well is going to run dry.
Exactly. So ask yourself this. What happens to the valuation of the last remaining hub of authentic human conversation on the internet if the massive tech giants suddenly decide that merely licensing this data isn't enough? And they decide they want to buy the well entirely?